I'm John Hanna for CDTV.net right here at Cipriani Wall Street with three other gentlemen. We have Mark Lucini, Chief Investment Strategist for Janney Montgomery Scott. We have David Weiss, Chief Economist for S&P. And we have Ernest Cruikshank, Chief Investment Officer for Jameson, Eaton and Wood. Thanks for joining us, sir. Thank you.
Thank you.
Now, let's start off with Ernest. Ernest, tell us about when you look at the automobile industry, how would you pick and choose your investments in that category?
In the auto industry, well, I think the auto industry is undergoing a terrific recovery from a very depressed base for reasons we all know. I think in terms of finding investment opportunities there, I think you've got not only the manufacturers, but also a lot of the suppliers. And I think the suppliers represent an interesting opportunity for investors to consider, given the fact that they've reached way beyond the U.S. and have moved overseas and are represented in most of the major auto platforms all around the world.
But in essence, like you have a starting money manager out there, what would you tell him or her about investing in the automotive industry?
It's cyclical.
There you go, straight from Ernest. 2 words, it's cyclical. Okay, now Mark Lucini, Chief Investment Strategist, Janney Montgomery. Same question. How do you look at automobile investments in your shop?
Well, I think actually I would piggyback on a comment that Ernie made, which is it's not only cyclical but dangerous because of that cyclicality. And it's very sensitive to movements in the economy and as well consumption. So as much as determining what individual automobile company or parts related to company or distribution company like a Penske Automotive or AutoNation might be of interest, one has to, I think, take somewhat of a macro perspective about what is the conditions in the U.S. and the global economy and where are auto sales going to come from. We've seen a marked recovery in automobile-related stocks. They were up about 75% in the aggregate in 2010. But I think perhaps some of the things that were the tailwinds to that lift are largely behind us at this juncture. So it's going to mean picking your spot is going to be exceedingly important. We're seeing increasing units sold here in the United States, trending towards about a 13 million annualized run rate. But I think importantly, where we're seeing faster growth, in fact expected to be about 10% next year or this year, is coming out of China. So we're as interested in not only the recovery in a cyclical industry in which an automobile company obviously participates, but as well those automobile companies that are going to be able to leverage their growth through distribution to fast-growing BRIC markets, particularly China.
David Weiss, Chief Economist for Standard & Poor's. What is your take on the automotive industry right now?
Well, the auto industry is starting to recover, but let's get real. We're at 12.6 million sales pace in January. 3 years ago, that would have been considered a disaster. Normal 16 million, 17 million. So we're still ridiculously low. The other point is, though, the industry has become much more global. In 2009, for the first time, General Motors actually sold more automobiles in China than it did in the United States. And unfortunately, at a much lower price point, the dollar value was a lot lower. But increasingly, you've got to look at world markets, trying to figure out who's a domestic company, who's an international company. Everybody is making cars, everybody everywhere, everybody is selling cars everywhere. So you've got to look more and more at the global economy, not just the U.S. economy.
Okay. The second question would be, what do you think of the auto bailout? Is this going to be the new norm now, just like the airline industry, where you get like a bankruptcy every couple of years for the companies?
For which sector?
I'm kind of comparing the airline industry with the automotive industry. Everybody keeps on filing for bankruptcy.
No, I think the auto industry is fundamentally different. Number one, there aren't as many companies involved. But more importantly, it's much harder to get into the business. One of the problems in airlines, it's almost entirely a fixed cost business. and it's very low barriers to entry. You can come in very quickly and just buy a plane and start operating. In the auto industry, it's much more difficult. And we've seen, I think, the companies do a pretty good job of downsizing, allowing themselves to make profits at much lower volume of sales. So I think it is fundamentally different. Does that mean you won't get car companies going bankrupt? Of course not. You will. There are new players coming in from the emerging markets particularly. There are going to be players going out in the developed markets.
Mark, same question for you.
Well, I think to David's point, I would agree that inevitably you're going to have some failures along the way. I think, though, that perhaps the lessons learned and the opportunity, if you will, to reset many manufacturing companies like a General Motors, for instance, and/or a Chrysler through its acquisition by Fiat, to deal with the issues that were looming over the automobile manufacturing industry, namely the exorbitant legacy costs, the overhead of the liabilities of the company, that bankruptcy, for good or for bad, helped to sort of either address and or wash away, enabled companies to start back at a much more level playing field to compete on a global basis. So inevitably it'll attract interest by participants who probably shouldn't be in the business of producing cars, which will lead to, again, some bankruptcies. But at the same time, it also means those that were threatened by bankruptcy have had a chance to kind of resurrect themselves back into a global business from a much healthier corporate position than they had been in a couple years before, which likely reduces their chances of falling back into that bankrupt state.
Ernest Cruikshank?
Well, I agree with those comments. I think the auto industry has learned a lot of lessons as a result of the challenges they went through and the bankruptcy experience. I think all American industry has had a wake-up call that it's a tough world that they're competing in, and you've got to be efficient, you've got to develop technology, you've got to manage your costs, you've got to manage your balance sheet, and I think the experience, although painful, is a good one long term for U.S. industry.
Now, let's talk about electric vehicles out there. What are your thoughts about it? And would you be more willing to invest in a company that has that as part of their plan going forward from here?
I may not be the best one to address this. Personally, I think that the market for electric vehicles is still one that's yet to be proven. I think a lot of what's being produced right now is being produced with a lot of government subsidy, and how economic these industries will be over the next 3 to 5 years, for me, it's difficult to assess that. Some of you all may have different views.
Mark Lucini?
I would, in fact, agree with most of those comments. I think the acceleration to adopt clean energy technology in the automobile industry, namely in the form of electric cars or even more broader use of hybrid vehicles, is really going to probably be triggered by a riot at the gas pump, meaning we're have to see something that would jar oil prices to some level substantially higher than where we are today to sort of reinvigorate the consumer to tap on their congresspeople to say, let's make more quick change to what it is we're doing, how we power our vehicles, natural gas or otherwise, because at $3 and change at the pump, you're seeing miles driven increase, you're seeing auto sales increase, you're seeing in fact a recovery in light trucks and SUV sales again. All that is indicative of a consumer who isn't necessarily changing their attitude with regard to the use of energy as it exists today, predominantly the source being oil.
David?
Yeah, I think that's the key. People will respond to gasoline prices. At the current gasoline price, people are saying that I would rather have the good old-fashioned SUV, not a nice new hybrid. So they're not making that choice. I think if you keep gasoline prices high, you'll get people much more concerned with conservation. The other thing on the technology side, the battery technology is not quite there yet. I think we need more improvements in battery technology before electric cars are operable. And even for the hybrids, the battery technology increases the cost given the current weight to power ratios that are required.
Let's talk about the consumer pocketbook. Um, with regards to, we see some signs of an economic recovery, and hopefully the jobs will follow after that. What dynamics do you see with regards to the consumer side as to make the consumer get a new car this year or next year?
Other than have a few more icy winters so we wreck some of the old ones. Basic point is people need to feel confident in their job in order to feel confident in taking out a car loan. I think that's beginning to come back. Layoffs have dropped down. We've seen borrowing increase. Revolving credit grows in December for the first time in over 2 years. I think we are seeing some of that beginning to come back. But the consumer is more cautious and ought to be. We're saving more, we're borrowing less, we're making the cars last longer, and we're realizing cars do last longer than they used to. So I think there's going to be a transition period here as we stretch out the life of cars on the road to probably a new higher average. By 2015 or so, you finally will have to replace that car, and I think you'll be back to more normal sales levels.
Okay. And Mark?
I agree that I think the key issue is consumer confidence, and confidence is going to be built on the foundation of seeing, rising incomes, job stability and/or job creation, and last but not least, probably some stability being brought to the housing market, so you feel as though your household net worth is at least stable, if not improving, directionally anyway, from one of the legs of that stool, which hasn't been very cooperative over the last couple of years. So I think it's some combination of those three ingredients that is going to be important to see us build on not just the recovery that we've seen in car sales, but actually any kind of restoration to the number of units sold that David talked about just several years ago, running at about a 16 million annualized pace versus where we are today.
Ernest?
I agree. I think we've got a deficit of demand that has built up over the last few years, and we'll gradually see that demand return, but totally dependent upon improved economy, particularly some employment gains. I think employment growth in 2011 and 12 will be a big factor in bringing back auto demand.
Thank you guys for coming in, and thank you for joining me at this luncheon here. John Hanna with CDTV.net in New York City, currently at Cipriani Wall Street. Thank you.